let's get started with the Fed interest rate hiking cycle sweeping across the world. So the 3-month U.S., or not U.S. in this case, global government bond yield across the world rose from 1.4% a year ago to 3.4%, which is up 2%. Now, this chart actually looks at every country in the world. It wasn't an easy chart to construct. And so how did I calculate this chart? Let's take a look at what I did. Well, I gathered the 3-month government bond yield across 52 countries for each month over a decade. And then I weighted each of those by that country's GDP. Consider that US GDP was about 26% of world GDP. So its 3.3% government bond rate contributed about 0.9% to the world's 3.4%. Or let's consider Pakistan, where GDP accounted for about 0.4% of global GDP. So its high 14% bond rate only contributed 0.1% of the world's 3.4% 3-month government bond yield. And that's how I calculated this particular chart, which you're going to look at more detail. So let's look at this in more detail. I can then take the data and break it apart between developed and emerging markets. And what we can see is developed markets went from negative 0.2 to 2.2 in 12 months. And emerging markets were already pretty high at 3.7. They were nowhere near where the developed markets were at 0, basically. And they went up to 5.2. And we can get a picture of that from this chart. And I just want to talk for a moment about this because the US is a great example of a country that has a fiat currency. When you have a fiat currency and you have the power of it also being a reserve currency, that's the key, that it's a reserve currency. What you're going to find is that that reserve currency, basically, you can lower interest rates all the way down to 0, and it's not going to hurt the currency too much. But if a country like, let's say, Thailand, as an example, or I showed Pakistan in the past, were to lower their interest rates down to 0, then no money would come into the country to buy their corporate or their government bonds. And the result of that is that there would be no demand for the currency, and it would eventually cause the currency of that country to devalue. So being a developed market with a reserve currency status like the US means you have the privilege of running interest rates down at basically 0. Now, there's a lot of stuff I'm covering today. So as I go through this, if you have any question on this topic or anything else, make sure just to type it into the chat. So let's continue on and try to summarize what we've just said. What are the key points and the bottom line? Well, the GDP weighted 3-month government bond yield across the globe rose to 3.4% from 1.4% a year ago, which is up a massive 2%. I mean, that is huge. Developed markets have gone to 2.2% from basically 0, which is up 2.3%. Emerging markets have gone to 5.2%, up from 3.7, so up by 1.5%. And US has gone to 3.3 from 0, which is up about 3.3. And Pakistan is now, as an example, I use Pakistan, so let's just mention its government bond yield is at 14.3 from 7.3, or up 7%. So what's the bottom line? The Fed interest rate hiking cycle is sweeping across the world. Let's look at the next thing that I want to talk about, which is looking at the developed countries and see what's happening with France and Germany and the US. So here we can see a chart that I constructed showing the developed markets in the Americas, which is mainly the US, have led the rate hikes. And we can see, actually, this chart is interesting because it just shows how high emerging market rates already were and how high they are. And the blue line that on this chart you'll see is the Americas, which is increasing from 0 up to 3. And so, in fact, you could see that the developed markets, America, is starting to close the gap with the emerging markets. And that gap has been very, very, the gap has been very wide. In fact, let me just grab my pen to mention what I'm talking about. I'm talking about the gap between the emerging markets and, let's say, the US right here. That's a 4% gap, but that's a much lower gap now. And so part of the reason why the US dollar is strong is because the interest rate on US dollar is strong relative to other countries. Now, almost all increases in developed markets are happening in the US and the UK. Here we can see the US and the UK, the red and the brown dotted line, have already risen substantially. So French and German short-term bonds are only now starting to rise. So we can see only recently did these start to really rise. So France and Germany have been in negative territory for a long time. And all of a sudden, only August. So this chart shows September, up to September, August, and July. So we can see that they're just starting to increase. Now, if you look at the CPI in Europe, in Germany, in France, it's out of control. So what are they going to do? I would argue that you probably are going to see the ECB or the central banks increasing rates, and those 3-month rates are going to rise pretty substantially. So why is there so much strength in the dollar? Because people are worried that the euro is going to be crushed from inflation because they haven't increased interest rates. So what's the key point and the bottom line that I want you to get from this section? Well, developed market Americas, which is mainly US, has led the rate hikes. And developed markets Americas is closing the gap with emerging markets government bond rates. And the US and the UK are the only major developed market countries aggressively increasing rates. French and German 3-month government bond rates are only now starting to rise. And Japanese, we didn't look at it, but Japanese short-term yields remain slightly below zero. Now, what is the bottom line? France and Germany are in a painful game of catch-up with the US when it comes to raising rates. And I believe that that is just one more painful thing that Europe is going through. One thing I want to mention here, and I just talked about this for a moment because we're going to look at this in a little bit, in just a little bit, is Japan. When Japan has kept, the government has kept the interest rate basically down at zero. When you keep interest rates so low, what happens? People are incentivized to borrow because interest's so cheap. Now, keep in mind that when the government has interest rates at zero, that doesn't mean that companies are borrowing at zero, but they may be borrowing at 1 or 2 or 3%. So you would think that the Japanese companies would be borrowing like crazy. So we're going to look at that in just a moment and see what is happening with these Japanese companies. Let's go back to the presentation. Before we get to the Japanese companies, we'll go through a couple of other things. But remember, it's Monday morning, 7 a.m. I got to have a sip of coffee. Delicious espresso. So feel free as I go through this to ask any questions that you may have. I know it's early, but you may have a question as I go through. Next, I want to talk about how emerging market rates have been higher but kept low by China and how frontier markets suffer the most. So there's a lot on this chart that I'm looking at. This is emerging market Asia, which has the lowest rates. Frontier markets have run away with their short-term government bond rates. And you can see this chart shows that the frontier markets are basically seeing this huge increase, almost to 20% for government bond rates. I'm going to explain more about what's happening there. But this is looking at mainly frontier and emerging markets. I put in the developed ones right here, which is that red line at the bottom, to show that developed markets is very low interest rates and emerging markets are pretty high, except emerging Asia. And emerging Asia really is China. Now, let's look at the top 5 emerging market countries: China, India, Korea, Russia, and Brazil. China bucks the trend with short-term rates falling from 2.4 to 1.7. China could really go either way. It's a difficult one to call right now. We have a slowdown of the economy and it could keep interest rates low, or a recovery could rev up inflation and demand and interest rates. It's very hard to call right now, but I would say that we're probably still in a low interest rate environment. Now, this is fascinating because what I started off the whole show talking about the power of free market capitalism. Well, we're not operating in free market capitalism. We have a Fed that basically sets the price of money, and they pretty much get it wrong almost every time. They flood the world with cash, and then they don't understand why inflation happens. In fact, you had Secretary of the Treasury, Janet Yellen, expressing kind of, there's no way we're going to have inflation. And then later, we're not going to have a recession. But let's just imagine that we believed in controlled markets where we need government bureaucrats to set the price of money. Well, this is what we call Keynesianism after John Maynard Keynes. And the idea is that when times are tough, the government should spend and decrease the interest rate to try to stimulate borrowing and economic activity. And when economic activity is super strong, they should be tightening, getting more revenue for the government out of that, and basically managing that. But in fact, what we're seeing with the Fed is they're kind of doing a bit of the opposite. I would argue that they are tightening in a really, really dangerous time, like a recessionary time, whereas now should be, basically, they should have been tightening during the boom that we had. We just had a decade-long boom, and they didn't tighten at all. In fact, they fueled the boom. And so they're forced to tighten now. And this, to me, is what free market is about, is free markets allow interest rates to rise, and participants in the market can't expand so aggressively because interest rates are rising and we don't get such a bubble. I would argue that the Fed caused this big bubble, and I think that the Fed is possibly causing us to go into a global recession. So let's go back. I saw a nice good morning from Wat Tan Yu. Nice to see you this morning. I'm going to have another sip of my espresso. And let's continue on. So also you can see Russia's short-term rates shot up. Now they've come down from there, but right now for my data set, I didn't have the data and I didn't have time to fill it in. So, but you can also see Brazil's interest rates have gone from about 5% up to 15%, a pretty large rise. All right, let's talk about frontier markets. Here is a map of the world, and my goodness, let's just take a look at it in full detail. And what you're going to see is, I'm going to talk about in the legend, in the numbers below the country. I'm going to show the the GDP of that country. So Argentina is oftentimes considered a frontier market. It's got $489 billion. And also Nigeria here, it's got $442 billion GDP. Then there's Vietnam at a $366 billion GDP. And then there's Bangladesh with a $357 billion GDP. And then Pakistan with a $348 billion GDP. Then we've got Kazakhstan. And I've talked about Kazakhstan last time, where I think that Kazakhstan is going to become a new hotspot because of all the rare earths that the country has. And then Sri Lanka now becomes a very lower, you can see an $82 billion GDP, which is actually pretty impressive when you consider it's a tiny, tiny little country. And then Jordan here in the Middle East, we can see at a $45 billion GDP. These are what's often called frontier markets. So now I want to add in an arrow, and you can see for Argentina, the top number in that upper arrow box is the current 3-month government bond rate. So you can see it's 70% government bond rate right now in Argentina. And the number below is how much it's up. So it's up by basically doubled. It's up by 35% compared to 12 months ago. Sri Lanka is at 29% for short-term government bond rate, and it's up 22%. So a massive increase. And we can see Pakistan's up 14. It's at 14% for the short-term government bond rate, which is up about 7%. Kazakhstan is at 15%, which is up about 6%. And then Vietnam is at about 6%, which is up 5 percentage points, meaning it was at 1. It has increased pretty massively. So why are frontier market rates rising so much? Well, if frontier market countries attempted to print and distribute money to relieve the pain their populations are facing, their currencies would get devalued in the Forex markets. There's discipline for countries, and the problem for the US is they don't face that discipline because all the printing of money and the government debt is not going to be punished right now with the US dollar. Now, as their currencies devalue, then imports become more expensive, and that's increasing domestic inflation in these frontier markets, since many of the countries are import dependent. They could be smaller countries and they just don't have as much resources. So they're forced to raise rates to stabilize their currencies and prevent runaway inflation. It's a painful cycle. Now, but the US can print money for years, yet the dollar strengthens. This is a chart of the US dollar index. And basically, the US has the privilege of being the reserve currency. So the US Fed can print without an impact on the value of the dollar. But the question is, can they do this forever? And of course, the answer is nothing lasts forever. But it's working right now. So let's sum up what you've learned in this section. Emerging Asia has the lowest rates. Frontier markets have runaway short-term government bond rates. China's short-term rate fell to 1.7 from 2.4. And a slow Chinese economy could keep rates low, or recovery could rev up inflation and rates. It's a tough call, but I would go with the interest rate and inflation being low in China for another 6 more months. Now, frontier markets are hit hard. We saw Argentina, 3-month rate was at 30%, which is up 35%. Sri Lanka was at 29% for the short-term government bond rate. It's up 22%. Pakistan was at 14%. It's up 7%. Kazakhstan at 15%, which was up 6%. And Vietnam is at 6%, up from 1 by 5 percentage points. Frontier markets are forced to raise rates to protect value of currencies and to prevent runaway inflation. Bottom line, emerging market rates have been higher, but kept low by China, and frontier markets suffer the most.